Welcome to the Hustle Class Podcast. We have a quick disclaimer. All material presented within Hustle Class LLC is not investment advice, but for educational purposes only. Trading involves risk, and you are solely responsible for your investment decisions and assume the entire risk of any trading you choose to undertake. Owners of Hustle Class LLC and its representatives are not registered as security broker-dealers or investment advisors, either with the United States Securities and Exchange Commission or with any state securities regulatory authority. Please utilize a registered investment or financial advisor to make any financial decisions. If you choose to invest without seeking advice from such an advisor or entity, then any consequences resulting from your investments are your sole responsibility. By utilizing Hustle Class LLC and our content, you are indicating your consent and agreement to our disclaimer. Hello, everybody. Welcome to the Hustle Class Podcast. It is another Wednesday. I'm your host, Jermaine, and I am back at it again with another one. You know how I do. I'm happy to be here. You know, health is wealth. I've been living a healthier lifestyle than I was at the end of 2020, and I feel great. Work's been piling up, but nonetheless, we move. And so I've been getting a lot done, getting a lot accomplished, trying to be consistent. So yeah, as you see, I'm here again on another Wednesday. I'm going to be posting episodes every Wednesday. It is free 99. All this information is for educational and entertainment purposes only. And if you ever want to act on anything, make sure you consult with a financial advisor. Losses are real, right? If you take risk in the stock market. That's that. I will say thank you to everybody who consulted with me on stocks. This past month, it was a great month. This is the first month I truly was promoting my consulting and really going hard with it. I had about 20 consultations, and that was great. And I appreciate everybody who decided to dedicate their time to learning something new and something that they can benefit from in the long run. I appreciate everybody who took that opportunity. Once again, I'm doing referrals. So if you happen to refer somebody to me for a consultation, I do give a portion of the proceeds to you for, referring them to me. We can all eat. That's like what I like to say. We can all eat together and, we can support each other and uplift each other, right? Great. So tying back to what we were talking about last week. Last week was the GameStop, AMC, Nokia, BlackBerry saga. People even started talking about silver in there, and it kind of went crazy. There's people are still saying hold the line and all types of things. Wall Street Bets is still going crazy about it, and so are a lot of people who don't know anything about stocks. They're really interested in it. But as we saw, all good things, come to an end. And so I wouldn't necessarily say it's over, but definitely a lot of the gains that we saw from GameStop are now kind of like simmering down. And, GameStop is kind of sitting in a little area or consolidating towards an average, if you will. Things are kind of slowing down for GameStop and AMC, but we'll see how things unfold. I got in a play last week, right? So I guess a moment of transparency. So I got in a play of Nokia, right? Or Nokia. And when I was in this play, right, I knew about all the squeezes that were happening, the short squeezes, and I knew that Nokia was a potential target. So I knew that even if Nokia didn't necessarily have the same type of short interest that a GameStop or AMC had, the fear of what had happened from GameStop and AMC might translate over to Nokia and people might begin to liquidate their positions. So when I thought of this and I saw that Nokia hadn't moved much, I decided that I would invest in the company or, buy a call option. I bought a call with a reasonable strike and a reasonable expiration date. And I put some money into it. Now, what happened was I actually went up in the position because Nokia shot up seemingly out of nowhere, right? Nokia shot up to about 500%. So I'm up 500% on this play. And because I understood what the swing of AMC did, because AMC went up the day before it went super crazy. And it kind of went up how Nokia went up for me. So I was like, you know what? Once people catch on, they're going to try to swing it. They're going to buy a lot at close, and I can make even more. What I probably should have done is taken some of my profit because I did have a couple of contracts on it. I didn't just have one because when options, you want to have contracts. And so I ended up holding all of them. The stock froze, right? And then Robinhood came out with their rule that nobody could buy. Now, this is a big issue that affected me like really poorly. And not only did it affect that trade for me, but it affected my trading psychology over the next couple of days, which I would say had a more negative effect on me than positive. So when Robinhood had decided to say that we're not going to let anybody buy this stock, right? That was what they said. We're not going to let anybody buy AMC, GameStop, Nokia, or any of these stocks anymore. We're going to take it off of Robinhood, basically. When they did that, so when you have options, there's something called implied volatility, right? Or I guess buying interest, or velocity/momentum. So when there's a lot of buying pressure, that drives the stock high, right? When a stock goes up, it's basically an imbalance between buying and selling. There are more buyers than sellers. When the stock goes down, there are more sellers than buyers. So when Nokia was going up tremendously, it is because there was all of a sudden an influx of buyers, and they bought Nokia so much that the price just kept on escalating because there were so many buyers. But adversely, when they canceled off the buying and said nobody can buy this stock, what happened? Everybody was selling. There was nobody to buy. So it was just a lot of selling, a huge sell-off. And all the gains I basically made, all that 500% came back down to 20%. It was quite ridiculous. And it was like one of the most shocking things that I'd ever experienced in the market, because this is never done for anybody, any of the little guys. You're never going to have a situation where, you're taking a pounding or you're taking an L, and they're going to shut things off so that you can, regain your, balance. But this is actually what ended up happening. And it was, that's why a lot of people are saying that Robinhood is going to face some class action lawsuits and things of that nature, because the idea that, for example, they said they were having a liquidity issue, right? If it's an issue that, is in regards to liquidity, what a lot of people are thinking, and what I think, and now Robinhood could come out and give us the reasons why we might be wrong in this, but what we're thinking is, if nobody can buy, make it so that nobody can sell either. They were saying that, oh, you know what, we didn't want to prevent people from selling because some people get into positions and they just want to get out. They don't want to be stuck holding it. Well, some people, I'm saying, it's the same for the other way around. So for them to make that argument for the seller, but for them to not make that argument for the buyer, like, don't you want to buy something that's going up? You know what I'm saying? Like, the same way somebody just wants to sell something and they don't want to be stuck in holding their position, somebody also wants to buy something with the hopes that it's going to go up. So when you cancel off the buyers and you only keep the sellers, only one side, it's not fair, it's not balanced at all. That is not fair or balanced by any means. It is one-sided. When you restrict buyers and only have sellers, the stock price is going to go down. It is going to go down. The reason being, one might say, well, nobody's going to have to sell their shares. That is correct. But anybody doing options is going to have an IV crush, an implied volatility crush, because there is no momentum with the lack of buyers. And so there's no velocity, there's no upward momentum. There's no pressure to go up. So when you have that lack of momentum, your options premium is going to get crushed, because one of the Greeks within your options Greeks is going to be implied volatility related. So, that was very, very unfair, and I was very disappointed to see that happen. And once that happened, what I mean by affecting my trading psychology is I was on edge, like Robinhood's going to shut down any second. They're going to shut things down. So even though I had plays that were really good, my thought that Robinhood was going to, I guess, start closing different trades just because they were doing well, my fear of that increased, and then I ended up cutting out of plays that I could have done very well in. And so I really am disappointed in Robinhood for doing that. And like everybody else, I'm thinking of, okay, where am I going to take my money next? Because a lot of us don't really rock with Robinhood right now anymore after that. So that was very, very disappointing. And it was actually quite interesting. We learned a thing or two. And somewhere in the fine print of Robinhood, it does say that at any point in time, they can restrict your buying or selling of anything. So I guess, once again, table of contents, they need to make it more readable for people, because, who can really read and retain, the 20 pages that make up, that table of contents, or, acknowledgments and agreements of services, So, that's that. But nonetheless, we move. So we're back into a new week with new opportunities. I personally am going to be leaving options for a while after that whole thing that happened. I'm thinking I'm just gonna slow burn my portfolio, just take it one day at a time. I'll definitely still be posting potential plays in the Forever Slow Stroking group hosted by our former co-host Eyon, who now has a podcast called the Forever Slow Stroking Podcast. He also has a stock group that I am administering with him, and I will still be dropping plays that I find as I refine my strategy and fine tune some things on my end, entry points and targets and things of that nature. And so I will still be posting plays in that group. If you want to join that group, the link is in the bio of this episode. So I'll still be in that group, and I'm still doing consultations for options, because even though I find good stocks that are good for swings, I could also find good option swings depending on the amount of volume that the stock potentially has and what our price targets might be. So you can definitely still find good options even if you decide not to take advantage of options trading, right? Because it's more risk. I feel like right now I'm not really looking for more risk. I feel like I'm trying to focus on grad school and other things. So I need to, reduce my risk, because I cannot spend as much time in the market as I would like. So that's that. I was gonna talk about some of the plays that we had brought up before the GameStop saga, just to see our progress on them. A lot of the plays that I come up with, I'm gonna be, I guess, going over them for like the month. So next week you should have new plays, but this week I'm giving kind of like a recap of the ones that we talked about 2 weeks ago, and then whatever plays we go over next week, we'll kind of just follow their progress and any new information we get about them as time progresses and things of that nature. So we're gonna grow together. If you invested in any of those trades that I talked about, the last podcast, you consulted with your financial advisor, and then he or she gave you the go ahead. He, she, or they, right, gave you the go ahead. We can, see your progress. Just today, the plays that we were talking about previously were up, greatly. So I'm very proud that I'm able to add value to people's lives. That's good. And so let's talk a little bit about them. So one of the plays that we talked about a while ago was GEVO, GEVO. It's still a buy. The price to book is still excellent. It was up 11% today, which is good. That's nice progress. I really like them because one of the things I really like about them is their debt to equity ratio. They have more equity than debt. That's amazing. We want to see that. They have more assets than debt. We want to see that as well. So I really like GEVO. From a financial, and fundamental perspective, when it comes to, the stock chart, what I like about GEVO is the fact that they actually, were seeming to cross the, the 8-day moving average. They were seemingly going to cross it downward, but they ended up, crossing back above it. And so since it's not even coming down to touch the 21 moving average, my assumption is that we're going to keep moving up, and, we're going to keep heading in a higher direction in terms of that stock. We're not even going to come back to test previous lows or to fill in any gaps. Another thing to consider is that a candlestick pattern on it is a bullish engulfing on the daily, meaning we should have some good upside, and it should test all-time highs. So we're looking good for GEVO. Price target of about 14. So that's great. Let's go to the next one, SPI. According to my analytical tool I'm using here, don't feel like disclosing it, but I'm sure a lot of you know what I'm using. So SPI, as I'm analyzing it from a fundamental perspective, still a very, very strong buy. It's not actually just a buy, it's a strong buy. It looks like, it's looking to break out soon. Maybe there's some news headed its way. Also has a very, very excellent, asset to debt ratio. The price to sales looks good. The price to revenue looks good. This company is one of the, what you see is what you get. And I feel like it still hasn't even cracked the surface, because as the Biden, the Biden team mobilizes and strategizes on how they're going to attack energy in this country, these are one of the companies that I feel like are going to benefit directly from it financially, in terms of the contracts that they might get and things of that nature. So I really like this company. I bought some. I'm thinking I'm going to buy more since it's still a strong buy at this point. If you look at its 52-week high and its 52-week low, we're closer to the low, which is great. That means a lot of upside potential. And if you look at the technicals, I love, and this is one thing I really love that I like to tell people, like when you look at a stock that has all the financial data to match it being high and currently it's trading low and the price has been beat down, I feel like a lot of it's beat down just because these hedge funds are trying to get better positions. They control the market, right? So if they can bring the price down, they can make sure that they have access to better prices to buy a stock. So this stock that, we're talking about right now was actually able to close, to open and close above the eight moving average, from a perspective of, the 8 simple moving average, we'll call it, from a perspective of the daily. And so, it ended up coming down and touching the 21 and then bounced up above the 8. So I think we have a lot of upward momentum. Here, it's probably going to test most recent highs of 12, and right now it's at 10, so we have about $2 to move. Doesn't seem like a lot, but $2 in relation to $10, right, is about 20%. That's great. A 20% move means you put in $1,000, you see 200. That's not bad. Risk 1,000 to see 200 is not bad. I think it is going to test new highs. We'll be mindful of it. We'll keep watching on it. But one thing about these companies, right, that I kind of bring up, I don't really like to bring in sort of like quick hit plays into the podcast. I like to bring good long holds, things that you can hold for a month at least, a year at most, right? Maybe even longer than a year, actually. You could probably hold a lot of these companies forever. But, I like to rebalance my portfolio continuously because there's always something new that's trending or that's popping. And I feel like opportunity cost of keeping my money in a company that has already had its buzz might not be the best use of it. But a lot of these companies have a lot of upward trajectory for a long time. So you can keep your money in it and just sit and wait. My favorite one I did that with was CrowdStrike, CRWD. Bought it at 50. Kind of bought it and forgot about it. A year later, I was up 500%, ridiculous amount of upside. And I could have kept holding it, but at that point, I was like, let me use this money elsewhere. So SPI, great. Another one that I want to talk about, that we talked about last time is BWEN. That's BWEN Incorporated. It's more on the upside right now than on the downside, because if we look at its 52-week range, its highest is 13. Right now it's sitting at 10.2. The reason why I like this company, also another great price to book ratio, a beautiful price to revenue, a beautiful price to sales. I really like their assets versus debt and their debt to equity. It looks amazing. And this is another company that is focused on clean tech. So they're on that wave of a cleaner America or a cleaner world, right? So this is a company that we're looking at heavy. So from a financial perspective, it looks great. From a technical analysis perspective, it just broke a wedge. So a lot of people are long on it, and I can't blame them. I like to draw like my my wedges to see when stocks are going to break out, and if they break out. If it's breaking out of a wedge on a daily time frame, that means the upside might be in for a while. We might see a lot of upside for a good amount of time. So I like what I see. I'm about to actually go to the chart right now and see what it looks like. So as I'm looking at the chart, looks like we're getting a MACD reversal to the upside potentially. That's good. Looks like we bounced off the 21-day moving average. So hopefully we're going to be able to go to the upside, test new highs around $12. So right now is a great time to get back in if you were in it and you left it for a little bit, because I think when we got it, it was a little cheaper. So it went up to about $13, came back down, and now it's going back up again. So this is another one that I might be loading up on. I think I'm going to load up on SPI. I'm going to load up on BWEN, and we're going to go to the moon. Well, if we can't go to the moon, at least we'll just chill in the sky, right? As long as we're up. So those are the 3 companies that I brought up last time, and so I decided to bring it up again so that we could chat about it, see our progress. Seems like right now we're up. In a little bit, I'm going to actually, I think maybe for the next episode to start, I'll talk about the progress at that point, and then we'll see how well we've done based on when I first talked about it on the podcast. So we'll see a little bit of our progress, see how we're doing. And then next week, hopefully I will have some different companies for us to look at. And then once we talk about those companies, we'll be in great shape. Great shape. So yeah, I don't want to introduce any of the companies I've been looking at now because it would be too long for me to give it an explanation. We kind of have been in this episode for a while now. So, I just want you guys to have a good week. Have a good rest of your week. Rest, relax. Time in the market is cool, but the market can be very draining. So make sure that as you're setting these plays, you set your stop losses and you just like set it and forget it. Let them do what they do. Let these companies work for you, and then see what the progress is after a while. Once again, thank everybody for listening in. I really appreciate it. This is Hustle Class. We're trying to see how we can monetize a little bit. We might have a Patreon going, or Patreon, whatever you want to call it, and things of that nature, so we can give more and also receive more, right? So thank you for tuning in, and we'll talk next week. Bye.